One of the many benefits of being a Motz Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the halftime report is Melissa Motz, president of Motz Wealth Management. She has over 25 years experience in the tax and financial industry, is a CFP, a CPA, and has a master's in taxation. This presentation was recorded on August 16th, 2012. Welcome everyone to our halftime report tonight. So I just want to remind everybody this is a great way to introduce friends, family members, colleagues to Motz Wealth Management in a very easy, relaxed fashion. So please keep that in mind for our future events. So here we are, a little more than halfway through 2012. Our agenda, we're going to start by exercising our brains, okay? Just kind of wake everybody up. And then we're going to have our year-to-date market review, what to watch for the rest of the year, our current environment, putting it in a historical context, and then some words of investing wisdom from people who are wise in investing. Okay, questions are always welcome throughout. Here we are, year-to-date market review. Okay, so this is up through June. So we can see domestic stocks were up 8.3%, foreign stocks 1.1%, gold 1.5%, and the dollar 1.8%. And we can see, look at oil. Up through June was down 14%. It's come back up quite a bit since then. That's Spain in general, the whole country. No, I'm just kidding. No, it's their equity markets. So that's where we are up through June. One interesting thing that as I was preparing for this, U.S. Treasuries, 30-year Treasuries. If you owned Treasuries, say a fund that had long Treasuries, 30 years, from a year ago till now, they were up 60%. Now I say that because they could go down that much, okay? People think Treasuries are safe and so forth. Well, if you own the Treasury bond, it'll go up and down in value. You'll just have to keep it the whole time to get your, original money back. But they are, can be very risky when, markets get so far out of whack. Okay, the United States of Europe. We've all heard a lot about this already, I think, just to touch on it. But, of course, there are 17 countries that make up the common currency of the euro. And the problem with Europe is that politically they are not together, but they're sharing a currency. So they're not able to print their way out of problems like we can in the United States. So they are on a path to become, fiscally joined, so to speak, but it takes time. It takes time for countries. If you go back in history even and you look at the United States at one time, states had their own currencies. Each state had their own money and so forth. So, it takes time for these things to all be worked out. And the problem is, will the markets give them the time necessary to be able to do that? And politicians can drag their feet. So we'll see what happens there. I don't think that, it's going to go under. It's, huge economy all put together. But it definitely has been a major driver of risk. This is interesting here. What this slide shows, this is 1993. Right here is the introduction of the euro, okay, as a currency. All right, this was back in 1998. So these represent the interest rates that countries were paying on their own debt. Every country issued their own debt. The blue, which was the highest at the time, we can see was Spain. So Italy was the red, and Portugal was the orange. So they had the highest rates of interest. And then the lowest rates were Ireland, France, and Germany. By all coming together, see what happened to their interest rates, all went down. So what happened were in these countries, Portugal, Spain, and Italy, they were borrowing at these high rates. Now they're borrowing at these low rates. So just imagine if that happened to you, and governments have a propensity to borrow. That's where they go crazy borrowing money because they get it at so much lower rates. Their rates got cut in half, literally. More than half. Here they are, all conjoined. And then this was the Lehman Brothers collapse in 2008. And then you can see they start to diverge here, and we all know if we watch the news or listen to it, we see what happens. So now Germany is the lowest, Portugal is the highest. Basically what happened was it became evident that they couldn't trust the collateral or the underlying assets that supported debt. So banks were suspicious of each other, liquidity dried up, banks wouldn't even loan to each other. It was a few years ago now, but it was a pretty crazy time. And that's when really what started happening was there were so many financial derivatives that were created that people didn't really understand what was backing them up. That's when they started looking under the covers and saying, okay, what is backing up these bonds? Well, Portugal isn't anywhere near as good a shape as Germany, so we should be, if I'm going to have a Portuguese bond, I should get a higher interest rate because I'm taking more risk. So that's what happened. People started looking under the covers then. So for Ireland, they have been getting their fiscal house in order. Yeah, because they've actually been pretty successful with their austerity measures. Gross domestic product, that term gets thrown around a lot. It's basically a measure of the size of an economy. Okay, it's everything, all the goods that are produced and services and so forth. So we can see in Europe, Germany has the largest. And we can see Greece, they got a bailout, Portugal, Ireland, Cyprus, most recently, and Spain. Now you look at Spain, those are billions of dollars actually, and Italy's having problems. You put Spain and Italy together, it's bigger than Germany. So that's why people are so freaked out by what's going on, Spain and Italy. Okay, that could be definitely a huge problem. So who's left of the countries like Belgium? They're pretty small to be bailing out Spain. Same thing with Finland. And part of the problem too is Italy actually is bailing out Spain. Yeah, it's a little bit crazy the way it's all kind of stacked up. So this is showing growth in our economy, essentially, growth in the GDP. So we can see 2008, what happened, went way down, negative. That's a recession, okay? Whenever you have negative GDP growth, that's a recession. And then we've come back since then. And I just want to kind of put this in perspective because from 1984 to 1998, we averaged 6.5% a year in growth in this country. Now it's less than 2, they're estimating. Going to be hard to grow our way out at those kind of numbers of all of our problems. Just keeping that in mind. We're not in recession. We could avoid a recession. Job losses. So the employment recovery is slow, and that's part of the problem, just like they were talking about Spain to Italy, and so you loan money, so who's going to pay, when they're not working, and all that kind of stuff. So we can see, actually, it's been since 1981 recession. See how what these lines measure is how many months it took to get back to where the employment level was from when the recession ended. And we can see how it's taking longer and longer. And the red line is where we are now. We're about halfway. So what that means is we lost 8.9 million jobs in the recession, and so far we've gained back 4.3 million. So we're not quite halfway there. And this shows that there, the 8.9 million jobs. Part of that, the problem is too, we have more and more people, graduating high school, college, et cetera, being added to the workforce. And those are related. That GDP needs to grow, our economies need to grow to be able to employ everybody that's able.